So in this video, I'm going to cover convertible bonds, so you have a better understanding of how it works, especially when it comes to the calculation. In convertible bonds, here are a few things you want to look out for. Par value, which is basically the face amount of the bond when it's issued and when it matures. We also have the market value of the bond. Market value of the bond is what the bond is being tradable at. And we have the conversion price of the bond. The conversion price of the bond tells us is the price that you can convert the bond, which will give you number of shares, which takes us to our conversion ratio. When you think about conversion ratio, you want to look at conversion ratio is how many shares of common stock will I receive in exchange of converting one bond. And then last but not least, you have the market price of the common stock. Once you can clearly identify what all of these means, then the Series 7 or the SIE question becomes very simplified. So for example, if a question is given to you that you have one ABC bond which was priced at par at the time you purchased the bond. The bond has a 10-year maturity, pays a coupon of 5%. The bond is callable at 102 and is currently trading at 103. The conversion price of this bond is $25, and the current market price of the common stock is $30 per share. What would you recommend your client do with this bond? Now, as you can see, you've been given a lot of variables. So first, once again, understanding the variables is super important. Now, we know that the bond is currently callable at 102, or we could say 1,020. We know the par value on a bond is $1,000. We know that the bond is currently trading at, so the market price of the bond is at 103, or we could say 1,030. Now, we've also been given the conversion price of $25, which will allow us to which will tell us how many shares of common stock we will receive in case we were to convert the bond. And then we've also been given the current market price of common stock, which is $30 per share. And the question just to find out is, what would you recommend your client to do? Which could be, should we let the bond get called? Should we sell the bond at market price? Or should we convert the bond into common stock? And how do we go about doing that? Well, the process is simple. Well, first we want to make sure is, because we know the callable price, we know the market price of the bond, we don't know how much the common stock will be worth if I was to convert it. So I'll have to convert the bond. And how do we convert the bond? We're going to take the par value of the bond and we're going to divide it by conversion price. And if we were to take that, we'll take $1,000 divided by 25, and I believe that gives us 40 shares of common stock. Now, another name for this could also be called conversion ratio, which will say the conversion ratio in this case is 40:1, which means I can convert one bond into 40 common stock shares. And now that we know that we have 40 shares of common stock, if we were to convert the bond, then all we have to do is we have to multiply that by the market price of the common stock, which is at $30. Market price of common stock. And if you were to do the math here, 40 times 30, that gives us $1,200 of common stock value if we were to convert. Then going back into the question, if you know the bond is callable at 102 or 1020, and we know the market price of the bond, or it's tradable at 103 or 1030, we know that when we were to convert it, the market based on the market price and number of shares, we'll say conversion ratio of 40, that gives us the conversion value of $1,200. So in this case, we won't call it, we won't trade it, we will actually convert the bond into common stock, which will give us the best option for our client.